Most people believe that wealth appears at a specific moment. A decision that worked out. An opportunity that arrived at the right time. A deal that closed when everything aligned. And while moments like these do occur, they rarely explain why certain individuals continue to build wealth across decades while others, working with similar energy and similar resources, find themselves circling the same financial position year after year. The gap is not always visible from the outside. Two people can earn nearly identical incomes, live in comparable neighborhoods, drive similar vehicles, and hold similar job titles. Yet 10 years later, one of them has accumulated substantial financial security, while the other has accumulated very little. The income was similar. The effort was comparable, but the outcomes are completely different. This is the question worth sitting with before anything else is explored. Why does the same amount of effort, applied over the same period of time, produce such dramatically different financial results for different people? The answer, when examined carefully, is almost never about effort. It is rarely about intelligence. It is rarely about a single decision, a single investment, or a single break that changed everything. The answer, when traced back to its origin, almost always points to something quieter and less dramatic than most people expect. It points to systems. Specific, repeatable, disciplined systems that quietly shape how money is earned, how it is managed, how it is protected, and how it is grown over long periods of time. Wealthy individuals, particularly those who build wealth steadily over decades, rather than through a single windfall, tend to operate inside structures that most people around them cannot fully see. These structures are not always complicated. In fact, many of them are surprisingly simple in design. But they are practiced with a consistency and a patience that most people underestimate. They are applied not during moments of inspiration or peak motivation, but during ordinary days, during periods of doubt, during times when the temptation to abandon them is highest. Understanding these systems does not guarantee a specific financial outcome. Nothing does. But understanding them changes the way financial decisions look, the way long-term planning feels, and the way daily habits are evaluated. And over time, that shift in perspective tends to produce results that feel almost invisible in the short term, but become undeniable over years and decades. This is where most examinations of wealth go wrong. They focus on the dramatic, the breakthrough investment, the company that sold at the right moment, the asset that multiplied in value beyond expectation. These events make compelling stories, but they are not the engine of lasting financial security. The engine, almost always, is the system running quietly in the background, shaping decisions on ordinary days, when nothing dramatic is happening at all. Consider for a moment what most people are actually focused on when they think about money. The majority of financial attention, for most people, is directed at income. At the number arriving in a bank account at the end of each pay period, at a raise that might come, at a side project that might generate additional earnings. Income is the primary lens through which most people view their financial lives. More money coming in means financial progress. Less money coming in means financial stress. The logic feels obvious. The more you earn, the better your financial position. But this is one of the most quietly limiting beliefs in personal finance, because income, on its own, does not build wealth. What builds wealth is the gap between what is earned and what is spent, and then the disciplined management of that gap over time. Two individuals can earn very different incomes and arrive at very similar financial outcomes, while two other individuals can earn nearly identical incomes and arrive at dramatically different ones. Income creates the raw material, but a system determines what happens to that raw material after it arrives. This distinction between earning money and managing money seems simple enough to understand intellectually. Most people can nod along to it without difficulty. But intellectual understanding and behavioral application are not the same thing. The vast majority of people who understand this concept still organize their financial behavior almost entirely around income. They focus on earning more. They assume that more income will solve the problems that their current income cannot. And sometimes it does, temporarily. But without a system for managing what arrives, a higher income typically produces a higher lifestyle rather than higher savings. The gap closes just as fast as the income expands. This is the pattern that appears with striking regularity across all income levels. A person earning $40,000 a year spends close to $40,000 a year. Then they earn $50,000 and spend close to $50,000. Then $60,000, then $70,000. And the spending expands to meet the earning at nearly every stage. The lifestyle adapts upward almost automatically. The home gets slightly larger. The car gets slightly newer. The vacations get slightly more expensive. The subscriptions accumulate. The dining habits shift. None of these changes feel dramatic in isolation. Each one feels reasonable given the new income level. But together they consume nearly every additional dollar that arrives, leaving the same thin margin between income and expenses that existed at the previous level. Wealth builders recognize this pattern and structure their behavior to resist it. They do not wait until they have more income to start saving more. They do not delay financial discipline until some future stage when saving becomes easier. They build the saving and investing behavior into the structure of their financial lives first, and they allow lifestyle to exist within whatever remains. The sequence matters enormously. When spending is addressed first and saving happens with whatever is left, savings tend to be thin or non-existent. When saving is addressed first and spending is managed within the remainder, the accumulation of capital begins regardless of income level. This reversal in sequence is one of the most consistent behaviors among people who build wealth steadily over time. It is not a complicated insight, but practicing it consistently across years and decades against the constant pressure of social expectation and lifestyle temptation requires a kind of financial discipline that most people have never explicitly developed. Discipline in financial behavior is not the same as deprivation. This is a critical distinction that often gets lost. Disciplined financial behavior does not mean living in a state of constant restriction, avoiding enjoyment, or refusing to spend money on things that matter. It means having a structure that ensures financial obligations to your future self are met before discretionary spending occurs. It means the investment account receives its allocation before the entertainment budget is considered. It means the emergency reserve is maintained regardless of what other spending opportunities appear. The structure creates a floor beneath the financial decisions rather than a ceiling above them. Without that structure, financial decisions tend to be reactive. They respond to mood, to social context, to immediate desire. The bonus arrives and feels like an invitation to spend. The credit card limit increases and feels like an expansion of purchasing power. The comparison with a neighbor's new purchase creates a subtle but real pressure to match it. None of these triggers are invented or irrational. They are natural human responses to natural financial stimuli. But when financial decisions are primarily driven by these reactive forces, rather than by a deliberate system, the accumulation of wealth becomes nearly impossible over the long term, because every decision optimizes for the present rather than for the future. Long-term thinking is not simply a personality trait that some people are born with and others are not. It is a practiced orientation. It is a perspective that has to be built deliberately and reinforced repeatedly, because the natural human inclination in financial behavior leans strongly toward the immediate. The reward that arrives today feels real. The reward that arrives in 20 years feels abstract. This asymmetry in how immediate and distant rewards are perceived is one of the most significant forces working against long-term wealth accumulation, and recognizing it is a prerequisite to building a system that compensates for it. The habit of delayed gratification in financial behavior is, in practical terms, the habit of making present decisions based on future outcomes. It means evaluating a purchase not only by how it feels today, but by what that money could become over time if it were allocated differently. It means tolerating a present condition that is less comfortable than what could be purchased in order to reach a future condition that is more secure. This is not a glamorous habit. It does not produce immediate satisfaction. It is quiet and slow, and often goes unnoticed by everyone, including the person practicing it. But its effects, compounded over decades, are not subtle at all. The difference between a person who consistently allocates 20% of their income toward long-term investments beginning at an early stage in their career, and a person who delays that behavior until their income feels sufficient, is not a small difference in outcome. It is an enormous one, not because of any single year's contribution, but because of time, because of the way consistent investment grows on itself, year after year, in a process that accelerates with each passing decade. Compounding is one of the most discussed concepts in personal finance, and one of the least behaviorally understood. Most people can explain it in principle. Returns generate returns, growth builds on itself. The longer the time horizon, the more powerful the effect. But understanding it in principle, and actually making financial decisions as if it were real, are different things. Truly internalizing how compounding works changes the emotional weight of early, small contributions. It changes the way a seemingly modest monthly investment feels. It shifts the lens from what this amount is today to what it becomes over time. And more importantly, it changes the emotional cost of delay. Every year of delay in beginning a consistent investment habit is not just a year's worth of contributions lost. It is a year of compounding lost. It is a year during which the existing capital could have been growing, generating returns that would themselves have continued to compound for the remainder of the investment horizon. This is why financial systems that prioritize early, consistent contribution tend to produce dramatically better outcomes than those that wait for higher income before beginning. The timing of the start matters in ways that are difficult to overstate. But compounding does not apply only to investment returns. It applies, in a meaningful way, to financial knowledge and behavioral habits as well. The individual who spends time understanding how different financial instruments work, how taxes affect investment outcomes, how interest rates shape borrowing costs, how insurance functions as a financial tool rather than simply an expense, gradually builds a compounding base of financial literacy that makes every subsequent decision more informed and more efficient. The early investment in understanding is modest in value, but it compounds in influence over time, shaping better decisions across every financial domain. Most people treat financial education as something that happens once, either through a course, a book, or a conversation with an advisor, rather than as an ongoing practice that deepens and refines over years. The result is that their financial knowledge remains static while the financial environment around them evolves. New instruments emerge, tax laws change, market structures shift. The person with a static base of financial knowledge responds to these changes with confusion or inertia. The person who has treated financial learning as a continuous practice adapts with greater confidence and makes fewer costly errors. This brings a related pattern into view. The individuals who build wealth steadily over time are not necessarily the ones who take the most aggressive financial positions or make the most sophisticated investment moves. Quite often, they are the ones who make the fewest costly mistakes. Wealth preservation, particularly in the early stages of accumulation, is often more valuable than aggressive growth. Avoiding large financial errors, keeping debt under control, resisting the temptation to invest in things that are not fully understood, maintaining adequate reserves so that temporary setbacks do not force the liquidation of long-term assets. These behaviors are not dramatic. They do not generate excitement, but they allow the compounding process to run uninterrupted over long periods of time, which is where the most significant financial outcomes are produced. There is a pattern in how people treat capital that they have recently acquired. Whether it is an inheritance, a business payout, a strong year of investment returns, or a period of high income, newly acquired capital has a particular psychological quality. It feels available. It feels like a resource that can be deployed, spent, or used in some productive way. The emotional response to new capital is often one of expansion, a sense that something new is now possible, that the constraints that existed before have loosened. Disciplined wealth builders have learned to resist this response, or at least to slow it down significantly. They treat newly acquired capital with a degree of caution rather than enthusiasm. They ask what the capital should do before they ask what they want to do with it. They evaluate it in terms of its long-term function rather than its immediate availability. This does not mean they never spend or never enjoy the results of their financial efforts. It means they make a deliberate evaluation before making an allocation, rather than allowing the emotional response to newly available funds to drive the decision. This is where the concept of assets and liabilities becomes practically important in a way that goes beyond its textbook definition. An asset, in the clearest financial sense, is something that generates value over time. It produces income, appreciates in value, or both. A liability is something that consumes value over time. It costs money to maintain, depreciates in value, or both. The challenge is that many things that feel like assets, particularly expensive purchases that signal success or status, are actually liabilities. The large home that requires constant maintenance and property tax and mortgage interest, the vehicle that depreciates the moment it leaves the lot and costs significant money to insure, fuel, and maintain. These purchases feel like acquisitions, but they are actually ongoing expenses. Disciplined wealth builders are not necessarily people who never make these purchases, but they approach them with a clear-eyed understanding of what these purchases actually are. They evaluate the total cost, not just the acquisition price. They consider what that capital could produce if it were directed toward genuine income, producing assets rather than depreciating ones. They make the decision deliberately, with full awareness of what they are choosing and what they are trading away. This practice of evaluating the full cost of a financial decision, not just its surface cost, is one of the more powerful analytical habits in long-term wealth building. The visible cost of a purchase is the price, but the true cost includes the opportunity cost. What that money could have become if it had been allocated differently. A $10,000 discretionary purchase does not cost $10,000 in the long-term sense. It costs whatever that $10,000 would have become over the relevant time horizon if it had been invested instead. For someone early in a wealth-building phase, that opportunity cost can be very large indeed. Internalizing this calculation does not mean every discretionary purchase becomes impossible to justify. It means the justification is made deliberately, with awareness, rather than impulsively. Impulsive financial decisions deserve particular attention because they are among the most consistent destroyers of long-term financial progress. Not because any single impulsive decision is catastrophic in isolation, but because the habit of making financial decisions based on immediate emotional states creates a pattern that continuously erodes the margin between income and savings. An impulsive purchase here, an unplanned upgrade there, a reactive investment made in a moment of market enthusiasm, a panicked liquidation of a position during a period of market decline. Each individual action might seem manageable in isolation. But as a pattern of behavior, repeated over years and decades, it consistently underperforms the alternative, a deliberate, systematic approach to financial decision, making that is not driven by the emotional state of the moment. Emotional discipline in financial behavior is not about suppressing emotion entirely. It is about creating a structure of decision-making that does not depend on being in the right emotional state. This is one of the reasons that automation in financial systems is so valuable. When the investment allocation happens automatically at the beginning of each month, it does not require the person to feel motivated that month. When the emergency reserve contribution is automatic, it does not require a conscious decision to prioritize saving over spending. The system executes regardless of emotional state, and this is precisely its value. The financial decisions that are made in emotional states tend to share a common quality. They optimize for the feeling of the present, rather than the outcome of the future. During periods of market growth, the emotional pull is toward increasing exposure, toward adding to positions that are rising, toward a feeling of participation in something that is producing visible results. During periods of market decline, the emotional pull is toward reducing exposure, toward protecting against further loss, toward the relief of exiting a position that is producing visible pain. Both of these emotional responses are entirely natural, but both of them lead to a consistent pattern of buying high and selling low, which is the exact opposite of what produces strong long-term investment outcomes. The discipline to resist these emotional pulls is not simply a matter of willpower. It is, more practically, a matter of having a clear investment framework in place before the emotional trigger arrives. An individual who has defined in advance what their investment allocation should be, what their rebalancing strategy is, and what criteria would actually warrant a change in their approach, is far less vulnerable to emotional decision-making than one who evaluates each financial moment without a pre-existing framework. The framework is not just an intellectual exercise. It is a protective structure that allows the long-term strategy to remain intact during the periods when it is most tempting to abandon it. Patience is a word that appears often in financial discussions and tends to get dismissed as generic advice. But in the context of wealth-building systems, patience is not a passive quality. It is an active practice of sustaining a strategy across time periods where the results are not yet visible and the temptation to seek faster results is present. Patience means continuing to contribute to a long-term investment portfolio during years when the market is flat or declining, without redirecting that capital towards something with a more immediate return. Patience means holding an appreciating asset through periods of volatility without liquidating at a lower price out of anxiety. Patience means allowing a business or investment strategy to develop over the time horizon it actually requires, rather than abandoning it prematurely in favor of something that appears to be working faster. The financial landscape is full of options that promise faster results, higher risk investments that could produce exceptional short-term returns, speculative opportunities that are compelling in the moment, strategies that appear to have worked dramatically well for someone else recently. For a person without a clear long-term framework, each of these options creates a genuine dilemma. They feel like potentially superior alternatives to the patient, systematic approach. But the individuals who build lasting wealth have generally learned to evaluate these opportunities not by their potential upside, but by the full distribution of their possible outcomes, including the scenarios where they do not work. Risk assessment is an analytical habit that separates disciplined financial decision-making from reactive financial decision-making. Understanding risk before taking it is not the same as avoiding risk entirely. All meaningful investment involves risk. The question is whether the risk being taken is understood clearly, whether the potential downside is tolerable within the broader financial structure, and whether the potential upside justifies the exposure given the alternatives available. Undisciplined risk-taking, which is common during periods of financial optimism or social pressure, tends to be characterized by a focus on the upside, while the downside is acknowledged, but not deeply evaluated. Disciplined risk assessment inverts this priority, spending considerable analytical attention on the scenarios where things do not work out, and only proceeding when the downside is both understood and acceptable. Capital protection is a principle that is undervalued by most people who are early in their financial journey, precisely because the instinct in early wealth building phases is to focus on growth rather than preservation. Growth feels productive, protection feels passive, but the mathematics of capital loss make protection deeply important. Losing 50% of a portfolio requires a subsequent 100% gain just to return to the starting point. The asymmetry between loss and recovery is one of the most important mathematical realities in personal finance, and it explains why protecting existing capital is often more valuable than pursuing aggressive additional growth. This is not an argument for purely conservative investment behavior across all stages of a financial life. It is an argument for calibrating risk appropriately to the amount of capital at stake and the time available to recover from potential losses. Early in a financial career, with modest capital and a long time horizon, higher risk exposure can be appropriate because losses, while painful, can be recovered through continued contribution and time. Later in a financial journey, With more significant capital accumulated and a shorter recovery window, the calculus shifts. Protecting what has been built becomes more important than maximizing the rate at which additional capital is accumulated. The individuals who navigate this progression successfully are those who update their financial strategy as their circumstances change, rather than applying a fixed approach regardless of their evolving situation. Financial systems are not static. They should develop and adapt as the financial life they are designed to support evolves. The strategy appropriate for a 25-year-old building initial capital is not the strategy appropriate for a 55-year-old approaching the period when that capital will need to provide income. Recognizing when and how to adjust is itself a form of financial discipline. There is another dimension of wealth building that receives less analytical attention than investment strategy, but has an equally powerful effect on long-term outcomes: the management of debt. Debt is not inherently destructive. Certain forms of debt, used strategically and managed carefully, can accelerate wealth building by providing access to productive assets that could not otherwise be acquired. But debt is a cost, and when that cost is not weighed carefully against the benefit it provides, it becomes a drag on financial progress that compounds in the negative direction with exactly the same mathematical power that investment compounds in the positive direction. Consumer debt, particularly high-interest revolving debt, is among the most consistent impediments to wealth accumulation, because its cost is not always psychologically vivid in the way that a direct financial loss is. It tends to accumulate without triggering the same alarm that a visible investment loss would. A person who would be deeply distressed to see their investment portfolio decline by several $1,000s in a month may carry several $1,000s in high-interest credit card balances without experiencing equivalent distress. Even though the financial effect is quite similar, the interest paid on high-rate consumer debt represents a guaranteed negative return on that capital, one that compounds against the holder with the same relentless mathematics as investment returns compound in favor of the investor. Disciplined wealth builders treat high-interest debt with urgency precisely because they understand this mathematics. They do not maintain investment positions while simultaneously carrying significant high-rate consumer debt as a long-term arrangement, because the arithmetic makes the combination financially irrational. The guaranteed cost of the debt exceeds the expected return of the investment, and the only rational approach is to eliminate the guaranteed negative before pursuing the uncertain positive. Mortgage debt occupies a different category. A home loan at a moderate interest rate, used to acquire a property that represents a reasonable portion of the overall financial picture, is a debt structure that can coexist with active wealth building. The interest rate is lower, the asset has potential appreciation value, and the leverage may make acquiring the asset more efficient than alternative approaches. But even with mortgage debt, the discipline of managing the total financial obligation relative to income and net worth is a consistent feature of long-term financial success. The person who stretches mortgage obligations to the maximum amount a lender will approve, leaving no margin in their financial structure, has created a fragile system that performs adequately under ideal conditions, but is highly vulnerable to disruption during periods of financial stress. Financial fragility is a concept that deserves more attention than it typically receives in discussions of wealth building. A financially fragile system is one that functions well under normal conditions, but breaks down when circumstances deviate from normal. It is characterized by thin reserves, high debt obligations relative to income, and a dependence on continued optimal conditions to maintain its structure. A financially resilient system, by contrast, has the capacity to absorb shocks without fundamental damage. It has adequate reserves, manageable debt obligations, and enough margin in the financial structure to accommodate unexpected disruptions without forcing the liquidation of long-term assets or the accumulation of high-cost emergency debt. Building financial resilience is not glamorous. It does not feel like progress in the same way that portfolio growth does. An emergency reserve sitting in a savings account earning modest interest feels like wasted capital to someone who is focused primarily on investment returns. But its function is not to generate returns. Its function is to ensure that the broader financial strategy can remain intact when unexpected costs arise, which they will, without disrupting the long-term investment structure. A person who has to liquidate a retirement account or take on high-interest debt to address an unexpected expense has paid a very high price for the absence of an emergency reserve, both in direct costs and in the interruption of their long-term compounding. The size and structure of an emergency reserve is one of the foundational decisions in building a functional financial system. The appropriate amount depends on individual circumstances, the stability of income, the variability of monthly expenses, the presence of other financial cushions. But the principle is consistent. The reserve should be sufficient to address the realistic range of unexpected financial disruptions without requiring a structural response to the broader financial plan. It is a cost of financial stability, not an inefficiency to be minimized. There is a behavioral pattern that appears consistently among people who struggle to build wealth. Even when their income is adequate, the absence of a conscious relationship with their own financial numbers. They have a general sense of what they earn and what they spend, but they do not engage with their financial data with the kind of regularity and precision that produces clear insight. They do not know exactly where their money goes each month. They do not know their precise savings rate. They do not know what their net worth is, or whether it is trending in the right direction. They have a vague awareness of their financial situation, rather than a clear picture of it. And this vagueness prevents the kind of deliberate decision-making that financial progress requires. Financial clarity is the prerequisite to financial improvement. You cannot adjust what you cannot see. You cannot optimize a system you are not monitoring. The practice of regular, honest engagement with personal financial data, reviewing what came in, what went out, where the gaps are, and whether the trajectory is moving in the intended direction, is not an optional feature of good financial management. It is its foundation. The time invested in understanding your actual financial picture is one of the highest return activities available, because it transforms vague assumptions into clear data and enables decisions to be based on reality rather than impression. This practice of financial monitoring also creates a natural feedback loop that reinforces disciplined behavior. When the monthly review reveals that spending in a particular category has crept beyond what was intended, the awareness itself tends to produce a corrective response. When the review shows that the savings rate has improved consistently over the past several months, the awareness reinforces the behavior that produced it. The data does not just inform decisions. It shapes behavior through the act of observation. There is a related habit in how disciplined wealth builders approach income itself. Rather than treating income as a fixed input to their financial system, they consistently look for ways to expand it, but with a specific orientation. They are not simply seeking more income to fund a higher lifestyle. They are seeking more income to expand the gap between earnings and spending, to accelerate the rate at which capital can be accumulated and deployed. This orientation means that income growth does not automatically produce lifestyle growth. It produces savings growth and investment growth, and the lifestyle is managed within a deliberate boundary rather than expanding by default. This requires a conscious decision about what the purpose of additional income is. When an income increase arrives, without a predefined answer to this question, it tends to be absorbed by lifestyle. When it arrives with a clear framework in place, it can be redirected toward financial goals in a way that accelerates progress significantly. The framework does not need to be rigid or permanent. It can evolve as circumstances change. But the existence of a deliberate orientation toward income growth, one that connects earnings to long-term financial goals rather than short-term spending capacity, is a consistent feature of the financial systems that produce lasting wealth. Lifestyle inflation is perhaps the most silent and consistent obstacle to long-term wealth accumulation. It operates largely below the level of conscious decision-making. Each individual instance of lifestyle expansion feels reasonable and proportionate. A slightly better apartment because the commute was uncomfortable. A newer car because the old one was becoming unreliable. More dining out because the schedule has become busier. A gym membership that did not exist before. A streaming service, then another, then another. Each individual choice is defensible on its own terms. Together, they represent a systematic absorption of income growth that prevents capital accumulation from occurring. The countermeasure to lifestyle inflation is not permanent restriction. It is the deliberate application of a framework that determines how income growth is allocated. A decision made in advance and revisited periodically that a defined portion of any income increase will be directed toward savings and investment before any lifestyle adjustment is considered. This is not a complicated system, but it requires the deliberate act of deciding before the income increase arrives how it will be used, rather than allowing the financial environment to make that decision by default. Social comparison is another force that consistently pushes financial behavior in directions that are inconsistent with long-term wealth building. The visibility of other people's consumption creates a kind of ambient financial pressure that is difficult to fully escape and difficult to consciously evaluate in real time. When someone in a similar social or professional circle acquires a visible status symbol, the psychological effect is real even when the rational response would be indifference. The human tendency to evaluate financial position relative to visible peers rather than relative to personal long-term goals is deeply ingrained, and it drives a significant amount of spending that has nothing to do with actual preference or enjoyment. Disciplined wealth builders have developed a clarity of purpose around their financial goals that insulates them, to a meaningful degree, from this external pressure. They are oriented toward financial independence rather than financial visibility. The goal is not to signal wealth through consumption. The goal is to accumulate capital that generates freedom. Freedom from financial constraint, freedom from dependence on continued employment income, freedom from the anxiety of financial fragility. These are not visible goals. They do not generate social recognition, but they are the actual outputs of disciplined financial systems practiced over time. Financial independence, understood in its most practical sense, is the point at which the income generated by accumulated assets exceeds the cost of the lifestyle being maintained. At that point, continued employment becomes a choice rather than a necessity. The financial anxiety that characterizes most people's relationship with money is fundamentally rooted in dependence. The recognition that the income required to maintain the current lifestyle depends on continued employment, and that any disruption to that employment would create a financial crisis. Financial independence resolves that anxiety structurally rather than just psychologically, because it removes the dependence that causes it. The path toward financial independence is not mysterious. It is the consistent application of the behaviors already described: earning adequately, spending deliberately, saving and investing systematically, avoiding costly financial errors, managing debt carefully, building resilience through adequate reserves, and allowing the compounding process to operate over a sufficiently long time horizon. None of these behaviors are particularly complicated in concept. The challenge is not in understanding them, but in practicing them consistently across the many years required for their effects to become fully visible. This is where the system becomes its own motivation, eventually. In the early stages of wealth building, the results are modest and the sacrifices are real. The gap between the lifestyle available in the present and the lifestyle that disciplined financial behavior enables in the future is at its largest. The temptation to collapse that gap by spending what is available rather than investing it is at its strongest. This is the period when the system is most likely to fail, and when the individuals who build lasting wealth distinguish themselves most clearly from those who do not. The distinguishing factor is not superhuman discipline. It is the ability to connect present behavior to future outcomes with enough clarity and conviction to sustain the behavior over time. The individual who can genuinely feel, on an ordinary Tuesday, when no financial emergency has occurred and no visible progress is measurable, that the investment made that month is building toward something real and meaningful, that person has a structural advantage over the one for whom that connection remains abstract and unconvincing. Building that connection is partly a matter of education and partly a matter of deliberate practice. Understanding the mathematics of compounding, modeling the long-term impact of consistent investment, projecting the financial position that current behavior will produce in 10 or 20 years. These exercises make the abstract future more concrete and give present sacrifices a visible meaning. They are not motivational exercises, they are analytical ones, and they are valuable precisely because they anchor present decisions to future outcomes in a way that the absence of deliberate financial planning cannot provide. There is an aspect of financial thinking that receives insufficient attention in most practical discussions of wealth building: the management of financial attention itself. Where a person's financial focus is directed determines, to a significant degree, the quality of financial decisions they make. The individual whose attention is primarily directed toward daily market movements, toward financial news cycles, toward the performance of individual positions over short time periods, is directing cognitive resources toward information that has very little value for long-term financial strategy and may actively harm it by creating the emotional responses that lead to poor decisions. The individual whose attention is directed toward the fundamentals of their long-term strategy, toward the rate at which capital is accumulating, toward the alignment between their investment allocation and their long-term objectives, toward the quality of their savings behavior relative to their goals, is using their financial attention in ways that actually support the outcomes they are seeking. The discipline of financial attention is a form of cognitive resource management that the most financially successful individuals tend to practice without necessarily framing it in those terms. This also means limiting exposure to information that triggers short-term emotional responses without providing genuine long-term value. Financial news is designed to produce engagement, which means it is designed to produce reaction. It emphasizes movement, uncertainty, and drama because these qualities generate attention. For a long-term investor with a clearly defined strategy, this information is largely noise. It describes short-term fluctuations in a system that is oriented toward long-term outcomes, and it routinely makes those short-term fluctuations seem more significant than they actually are from a long-term perspective. The discipline to engage with financial information selectively and purposefully, rather than reactively and continuously, is one of the quieter advantages that disciplined wealth builders maintain. They are informed about their financial positions and their broader financial environment, but they are not dominated by the noise of daily financial information. They evaluate their strategy at appropriate intervals, rather than continuously monitoring positions for evidence that the strategy should be changed. There is also a consistent quality in how disciplined wealth builders approach financial decisions under conditions of uncertainty. All meaningful financial decisions involve some degree of uncertainty. Future outcomes are never fully knowable. The question is not how to eliminate uncertainty from financial decision-making, but how to navigate it with appropriate humility and discipline. The response to uncertainty that produces the best long-term outcomes is neither paralysis nor recklessness. It is the construction of a financial strategy that is robust across a range of possible outcomes, rather than optimized for a single expected scenario. A strategy that performs adequately across many possible futures, including the uncomfortable ones, is more valuable than a strategy that performs brilliantly in the most optimistic scenario, but fails catastrophically in others. This is one of the practical arguments for diversification, not as a generic recommendation, but as a structural response to the reality that the future is uncertain, and any single concentration of financial exposure carries the risk of significant loss if the bet does not work out. The disciplined management of concentration risk is one of the consistent features of financial systems that survive and prosper across changing economic conditions. The longer the time horizon under consideration, the more economic conditions will change. Interest rate environments shift. Inflation rises and falls. Specific industries that are dominant in one decade become less significant in the next. Asset classes that have performed strongly for extended periods eventually enter periods of weaker performance. The financial system that is built for flexibility, that is designed to function across varying conditions, rather than to depend on the continuation of any specific environment, is far more likely to produce consistent long-term results than one that assumes the future will resemble the recent past. This requires a certain intellectual humility that is not always comfortable. It means acknowledging that the conditions that have made certain financial strategies successful recently are not guaranteed to persist. It means maintaining exposure to a broader range of outcomes than the most optimistic scenario suggests is necessary. It means accepting a modest reduction in potential upside in exchange for a meaningful reduction in potential catastrophic downside. For individuals who have spent years building the capital at stake, this trade often becomes increasingly rational as the accumulated wealth grows. At a certain point in the wealth building journey, the focus shifts from accumulation to preservation. This shift is not a failure of ambition. It is a rational recalibration of priorities in response to changing circumstances. The individual who has accumulated significant capital has different financial objectives than the one who is beginning the accumulation process. The behaviors that produce the growth, consistent contribution, strategic risk taking, long-time horizons, are not entirely abandoned, but they are modulated to reflect the new priority of protecting what has been built while continuing to grow it sustainably. The management of this transition is itself a skill that requires deliberate attention. The investor who was well served by a high equity allocation during the growth phase of their financial life may find that the same allocation creates unacceptable volatility as they approach the period when accumulated capital needs to begin supporting their lifestyle. The business builder who reinvested aggressively when they had time to recover from setbacks may find that a more conservative approach is appropriate when the consequences of a major loss are no longer easily recoverable. Recognizing when the situation has changed and updating the strategy accordingly is one of the more sophisticated aspects of disciplined wealth management. There is also a dimension of financial behavior that is easy to overlook in discussions focused on investment and accumulation, the management of insurance and financial protection. Adequate insurance coverage is not an exciting topic. It does not generate the kind of enthusiasm that investment returns do. But for anyone who has spent years building capital, the absence of adequate protection can reverse significant financial progress in a short period of time through events that have nothing to do with investment performance. A major medical event, a liability claim, a business disruption, a property loss, any of these can impose very large financial costs on a system that is unprepared for them. Disciplined wealth builders treat insurance as a structural component of their financial system rather than an optional expense to be minimized. They assess their exposure to catastrophic financial risk, evaluate the cost of transferring that risk through insurance, and make deliberate decisions about which risks to transfer and which to retain based on their capacity to absorb losses. This is not a passive or reactive process. It is an active component of the financial planning that ensures the wealth being built is not vulnerable to events that could be insured against. Tax efficiency is another dimension of wealth management that has a significant cumulative effect on long-term outcomes but tends to receive less attention from individuals who are focused primarily on income and investment returns. The amount of wealth that is retained from a given level of financial activity depends not only on how well the money is invested, but on how efficiently the tax implications of financial decisions are managed. Tax-advantaged investment accounts, strategic timing of income recognition, thoughtful structuring of charitable giving if relevant, awareness of the tax implications of different investment vehicles. These are not exotic strategies, but their cumulative effect over decades of financial activity can be very substantial. The individual who consistently makes financial decisions with awareness of their tax implications will, over time, retain significantly more of their earnings and investment returns than one who makes otherwise identical decisions without this awareness. This is not about aggressive tax avoidance strategies or complex financial engineering. It is about the basic practice of understanding how different financial decisions are taxed and where legitimate choices exist. Selecting the more tax-efficient option. The compound effect of tax efficiency is one of the more underappreciated drivers of long-term wealth accumulation. Because the tax impact of a decision is often deferred or invisible in the short term, it does not register with the same emotional weight as investment performance. But over a multi-decade financial life, the difference between consistent tax, efficient decision-making and inconsistent attention to tax implications can represent a very significant amount of capital. The systems that build wealth operate across multiple dimensions simultaneously. They manage income and spending. They direct capital toward appreciating assets and away from depreciating ones. They ensure adequate reserves are maintained. They manage debt carefully. They invest consistently and patiently. They protect against catastrophic risk. They minimize unnecessary friction from taxes and fees. They resist the emotional impulses that lead to poor financial decisions, and they persist across long time periods, adapting to changing circumstances while maintaining their fundamental orientation toward long-term financial independence. No single component of this system is the secret ingredient that produces wealth. It is the combination of these behaviors, practiced consistently over time, that produces the outcomes that observers from the outside sometimes attribute to luck or to exceptional intelligence. The individuals practicing these systems are not necessarily more talented than those around them. They are more consistently disciplined. They have built structures that support good financial decisions, even when the emotional and social pressures point in other directions. And they have sustained those structures across the years and decades required for the compound effects to become undeniable. Financial habits, like most habits, are easier to sustain when they have been practiced long enough to become automatic. The person who is in the early stages of building disciplined financial habits must work against default tendencies, must make conscious decisions to allocate savings before spending, must resist impulses toward lifestyle expansion, must maintain patience when investment returns are modest or negative. This requires active effort and deliberate attention. It is genuinely more demanding than the alternative. But over time, as the habits consolidate, as the system becomes established and the decisions within it become more automatic, the cognitive and emotional cost of maintaining the system decreases. The investment allocation that once required a deliberate decision becomes an automatic process that happens without friction. The impulse toward immediate financial gratification that once required active resistance becomes a weaker pull, because the alternative orientation toward long-term outcomes has been reinforced consistently over time. The system becomes its own infrastructure, reducing the effort required to maintain it with each passing year, and then the outcomes begin to be visible in ways they were not earlier. The net worth tracking begins to show a trajectory that was not apparent in the first years of disciplined saving. The investment account, which grew modestly in its early phases, begins to grow at a rate that reflects the compounding effects accumulating over time. The financial resilience that seemed abstract in the absence of any major disruption is tested and holds, demonstrating its practical value in a concrete way. The financial independence that seemed distant begins to feel achievable within a realistic time horizon. These moments of visible progress are not the driver of the system. The system was built and maintained during the long periods before any of this was visible. But the moments of visible progress reinforce the validity of the approach in a way that makes it easier to sustain. They are evidence that the patience has been warranted, that the discipline was not misplaced, that the quiet, unglamorous work of building and maintaining a financial system over long periods of time produces real results that cannot be easily dismissed. The financial landscape will continue to evolve. New instruments will emerge. Market conditions will shift. Economic environments will change in ways that cannot be fully anticipated. But the fundamental dynamics that make disciplined financial systems effective do not change with the landscape. Compounding remains mathematically powerful regardless of what investment vehicles it operates through. The gap between income and spending remains the primary driver of capital accumulation, regardless of what economic era is in effect. Emotional discipline in financial decision-making remains valuable regardless of what specific market conditions are producing the emotional pressure. The principles are durable even when the environment around them is not. This is part of what makes financial systems, rather than financial strategies optimized for specific conditions, the more reliable foundation for long-term wealth building. A strategy that was perfectly calibrated to the conditions of a specific era becomes less effective or outright ineffective when those conditions change. A system that is built on durable principles of financial behavior remains functional across changing conditions because its effectiveness is not dependent on any specific set of external circumstances. The individuals who build lasting financial security do so not because they found the perfect strategy for a particular moment in financial history, but because they built systems that remained effective across many different moments. They were not always right about specific financial decisions. They made errors. They faced periods of poor returns, unexpected costs, and disrupted plans. But the systems they had built were resilient enough to absorb these setbacks without derailing the long-term trajectory. This resilience is not accidental. It is engineered into the system through the deliberate practices of maintaining adequate reserves, managing debt carefully, diversifying financial exposure, and making decisions based on long-term frameworks rather than short-term conditions. The system is designed to keep functioning even when specific components of it are underperforming, and this design is itself a product of the disciplined thinking that characterizes every other aspect of effective financial behavior. As a final observation before this exploration comes to a close, it is worth reflecting on the relationship between financial systems and the broader quality of the life they are meant to support. Disciplined financial behavior is not an end in itself. The accumulation of capital is not the ultimate purpose of a financial life. The purpose, for most people who pursue financial independence, is the freedom that capital provides: freedom from financial anxiety, freedom from dependence on income from employment, freedom to make choices based on personal values and priorities rather than financial necessity. The system is in service of that freedom. And understanding this relationship, keeping the purpose of the system visible and connected to the behaviors that support it, is part of what sustains the discipline over the long periods required for it to produce its effects. The person who is merely deferring consumption has a difficult motivation to maintain. The person who is building toward a specific and meaningful kind of freedom has a much more durable one. Most people search for the moment that changes everything, the decision that reverses the financial trajectory, the investment that produces sudden, dramatic growth, the opportunity that arrives and transforms the picture overnight. These moments are compelling to imagine and rare to experience. And even when they occur, their effects are rarely as durable as those of the quiet systems that operate every day without drama or announcement. Lasting financial security rarely comes from a single moment. It comes from the structure of thousands of ordinary moments, each shaped by a system of thinking and behavior that consistently prioritizes long-term outcomes over short-term comfort. It comes from the savings that happen automatically at the beginning of each month, from the investment that is held patiently through periods of uncertainty, from the purchase that was evaluated carefully before being made, from the debt that was managed deliberately rather than allowed to accumulate, from the reserve that was maintained even when it felt like idle capital, from the financial knowledge that was built gradually over years and applied consistently across decisions large and small. The system does not announce itself. It does not produce visible results quickly. It does not generate excitement or social recognition in its early stages. But over long periods of time, it produces something more valuable than any of those things. It produces financial independence, built quietly and steadily, through the disciplined repetition of behaviors that most people understand in principle, but fewer practice with the consistency that produces lasting results. Once the structure of these systems is understood clearly, the financial decisions of daily life begin to look different. Not easier, necessarily, but more legible, more connected to their actual long-term consequences. And that clarity, once established, is itself one of the most powerful tools in the entire system.